Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading report for September 20th, 2014. We've got a market that is in bullish normal conditions. On an annual basis, using weekly RSI 14, we're at the higher end of neutral with a score of 67 out of 100. The threshold for overbought on that is 70. Shorter term basis, using the 10-day NDX, we're at also the higher end of neutral with a score of 73 out of 100. The threshold there is 80. Looking at the market mosaic, long-term trend, price relative to the 200, we're in yellow bullish conditions at 6.92%, meaning we've got about a 5% cushion to sideways markets. The slope of the 50 is neutral at 0.23. ADX has weakened to non-trending at score of 17.5. Volatility remains relatively normal at 0.75%. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading is at 0.98, which favors risk off trades. If we take that score of 0.98 and compare it to the last 5,000 trading days, that gives us the risk Z when we find the standard deviation and the Z-score. And the Z-score right now is minus 0.37. And you can see a 90-day time series of that indicator here on the histogram. And you can see that after a move from minus 2Z to plus 1.5Z, back down to 0, we're right at minus 0.34. Both of these moves were decent trades. This was a nice swing trade on the long side in XIV. This period of time, as that began to decay, were some nice intraday one-day trades with VXX. Really looking to see this start to hold support here around minus 0.5Z and resume. If that were to be the case, that would be a very favorable long side opportunity for swing trades, position trades, and then the XIV swing trade. Haven't quite seen that yet, but we're getting close in the market. These are the blended monthly rebalancing holdings. The next reevaluation is due on or about 1 October. These are the current leaders based on the price action as at the close on Friday. In ETF2, the theoretical exposure is at 40%. The model portfolio itself is at 80% exposed. Just for your reference, some quick looks at the ETF 13 and 32 portfolios using the blended monthly rebalancing frame of reference. You see about half of them are on cash positions, technology, Latin America, and U.S. large caps leading the way. The internationals generally lagging. And the same patterns in the 32 ETF portfolio, but with China near the top. This is the ETF Max data set with about 1,300 ETFs to consider, and these are the top 50. I'm interested in those that are green and then white. So green on 6 months and green on 3 months, white on 6 months. Suggests an opportunity that we may be able to get in earlier in something that's beginning to expand, and so that would lead us towards biotechs. You're in position number 7, and more biotechs here in position 32. Healthcare's Spider still doing very, very well. Great long-term position that gives you large caps, a great sector, and the U.S. market. These are the top 40 or so members of the S&P 500 through the same lens. Amgen is of interest. U.S. Steel continues just to march powerfully up, and you can see the sector Spider that these symbols are in. And with the strength in XLV, Vertex, Tenet, and Gilead, Edwards Life Sciences, Amgen, these are all things that we can be focusing on to drill down into the strongest companies in the strongest sector in the strongest regional market, which is the U.S. Market health check. The vertical blue lines are 10, 20, and 30 days worth of look back. The red horizontal lines are support levels that used to be resistance levels, and which give us reason to trust in some support here, or to frame trades based on support like at 198.5. And at the same time, these act as price targets on the way down if that support were to fail. I like that we're above the river right now. That's the dark blue shaded area. That's the 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the floodplain. That's the 30-period Bollinger Band plus or minus 2. The blue channel lines are the 10-period, regression line, and then the channel formed by the max excursion during the look-back period. That's the RAF regression channel. The black lines are the 30-period regression channel lagged by a day, so that we can see if today's price action violates the previous 30-day channel. And you can see that in both cases we are at or slightly above the midline of the regression line, so we're at fair value based on regression analysis. Slope of the river is up. Prices outside the river is pulled back to the edge of the river. If it holds support here and shows any kind of strength, that's going to be a very favorable sign. This pink looking ribbon is the dragon, or the 10-period Bollinger Band plus or minus a half. That gives us early warning about turns in the river. And so when the dragon gets violated to the downside and then back to the upside, we have the potential for increased trends. In the last couple, 2-3 days, we've seen that hinting towards an upside move. And so as long as this dragon holds, I definitely have a long side bias. You can see the slope of the 30-period regression line expressed in this sine wave looking chart, and the blue circles show where that has made intermediate turns, and that's usually a pretty good confirmation of a change in trend. This was as steeply up as it has been in the last 4 months. You can see that's as steeply up as it got before, just before this period of pullback. We've had a little bit of pullback because of those 10 days of price action, but it's still well above this dotted line, which is the zero line. So this would be a natural place for it to resume that northward move. So we're still bullish. We've been into overbought territory for a while, except for this little pullback. And now you can see the jaws of percent price oscillator have closed for the downside move and are prepared to open to the upside. So this is actually a pretty important turning point and decision point for the market. It's in a critical state. It's above the previous swing high. It's at all-time highs. There was a measured pullback on Friday, but it could find logical support here at what was once resistance, and then that would set the stage for the next leg up, which could look like this last move here from June through July. So I'm cautiously optimistic on the market condition right here. The ETF2 regional report, 6 out of the 10 regions are on cash signals, and that puts us at 60% cash, 40% invested in the market model, the allocation model. The S&P at 85 is better than EFA, the globals, at 72, so the U.S. is really dominating here. Inside the U.S., it's 79 versus 72. That 85 is the technology. Sorry about that. Inside the U.S., it's 85 in the techs, then 79 in the large caps, 75 in the mids, and then the small caps continue to lag at 70. The two strongest sectors, Latin America at 82, technology at 85. Two weakest are IEV, which is the European 350, and the U.S. small cap. So a real divergence inside the U.S. Looking at the sector spiders, real strength in technology and healthcare, weakness in energy. World market model kind of reports the same stats using the ETF2 lens. U.S. is above average, the technology exceptionally so, except for the small caps, which in the yellow are in the third quartile in the database. Real strength in Asia and Asia less Japan, with the exception of Malaysia and Australia. See, Japan is actually marching pretty well. Everything Europe is weak. Latin America, emerging markets, Mexico and Brazil, the Western Hemisphere is dominating right now. Underperformance by commodities, oil, gold, and silver. Private equity starting to lag. And then treasuries, corporate bonds, and real estate had a little boost this past week. The strength in technology and healthcare is reflected both in the U.S. and globally. And when you compare business sectors, the U.S. has a slight advantage across the board. The ETF top 30 using the ETF2 lens. Again, the greens across the board are long-term strong positions. Those that are green and white are signs of emerging and developing strength. So those should be on our short list for continuations and further exploitation, like technology, biotech, Philippines, and so forth. This is the Dow through the same lens. Strength in Intel, Microsoft, Home Depot. Those three are auto continuation patterns for me. If I see the market going up and these going up faster than the market, then it's a no-brainer to keep piling on. Disney and Nike have joined the parade. United Health also strong. And then more emerging strength in Procter & Gamble, Goldman, Cisco, Intel, Johnson & Johnson. Only United Tech right now in the red inside the Dow. And so you can see the strength in U.S. large caps reflected in just how many are above average, i.e. white or green on strength. ETF liquidity stats just for your reference. And shifting now to the daily report for Monday based on Friday's closes. Channeling and overreaction signals here, Asia less Japan, and then channeling for small caps, Asia less Japan, Latin America, and emerging markets. You can see the 10-day max pain and min pain leaders and laggards in terms of price relative to their 10-day highs. The 10-day max pains are the ones that are furthest away from their 10-day high, have suffered the most, if you will. You can see the return of some volatility here in this last little spike, and it's now back up to the 100-day average. And you can see that the trendiness is starting to improve here. It dipped almost to 15 and has now started to hook up. That's actually very favorable for swing trades on the long side as it starts to hook up. And you can see that the bulls are in charge. Channeling signals in a number of the indexes along with Caterpillar. Overreaction signals for real estate in Asia less Japan. Triple screen in Intel, which has been a tech leader, so that should have your attention. And then these auto framer candidates are all symbols that test out better than 2-to-1 simply on the basis of trade location between current price and the 10-day high. Quite a few good frog candidates, better than 3.0. Only Caterpillar is firing on the RSI2 with a score of 8. You can see how much it's lost here over the last look-back periods. It's 2.3-to-1 on the auto framer, number 1 on the MPRC. It's a max pain and a channeling candidate, so it's on my short list. You may be interested in Microsoft, Verizon, McDonald's, and AT&T on continuation patterns. If you see them outperforming the market while it's going up, those are relatively low-risk one-day trades. In the ETF 30 tactical, you see quite a few signals here on the auto framer. 3 on the RSI2, that's agriculture, coal, and silver. Silver is exceptionally interesting to me. Between 17 and 20, it seems like a reasonable trading channel. Half a dozen channeling signals, a couple overreactions as well. The stats from the auto framer that test out better than 2-to-1 from the Dow 30 and the ETF 30, and sorted by their reward to risk ratio, with the key price levels noted for mechanical trading. The regression line fractal format framework concept shows the symbols that are furthest above and below their own 270 period regression line, which we trade as fair value, and that's adjusted for their ATR. So in their reward to risk ratio, you see how many ATRs away from their 270 they are respectively. These in green are the most below, and so that's sort of a reversion to the mean trade on the upside. So you read this by saying that Caterpillar is 6.13 ATRs below its own 270 regression line. And then these in red down here in this section are ones that are well above their 270 and moving out smartly. You can think of these as the relative strength leaders that are creating new value on the way up, have already left the consensus behind. So that's relative strength on the move up. And you can frame your trades on that basis. Market mosaic, we've crossed the 30-period regression line, has crossed its 10-period moving average, which makes this a little bit vulnerable in here. However, we do favor the upside as long as these support levels above 200 can hold. That's everything I wanted to cover in the on the weekend report. Tonight's webinar will focus on charts of interest and specific trade frames coming out of the report for members. And so we ask you to keep your risk measured and your powder dry. Take good care.